In the land of opportunity, where dreams are nurtured and innovation thrives, a shadow looms large. The United States of America, once the beacon of economic prosperity, is now grappling with unsettling questions. From Wall Street to Main Street, whispers of economic decline are growing louder. But how did the world's largest economy find itself on the brink of collapse? What forces are at play, pulling the strings behind the scenes? Is the American dream turning into a nightmare? Let's unravel the mystery as to why, really, is America's economy collapsing? The economic landscape. The United States, known as the world's principal financial center, has been the epicenter of the principal American metropolitan economy. As of now, with a GDP of $26.854 trillion, it stands as the world's largest economy by nominal GDP and the second largest by purchasing power parity, PPP. In addition, the US dollar, backed by a large US Treasury market, serves as the world's reserve currency. However, it hasn't always been like this. While the American economy has seen periods of significant growth, the decline has also been there. During the Great Recession of 2008, the US economy suffered a substantial downturn. The American Reinvestment and Recovery Act was passed, leading to the longest economic expansion on record by July 2019. However, recent years have shown signs of slowing growth, with GDP growth rates of 2.1% in 2022, 1.6% in 2023, and a forecasted 1.0% in 2024. Despite its economic prowess, the US also faces rising socioeconomic inequalities. The Gini coefficient, a measure of income inequality, stands at a high 48.9. Additionally, 11.6% of the population live below the poverty line in 2021. This disparity between the rich and the poor has led to social unrest and economic instability. But the inequality alone couldn't have pushed the country to the brink of economic collapse. There are some other forces at play here too, which are far more significant than these trivial issues. The real underlying factor behind the economic failure includes 1. Rising interest rates and inflation. The Federal Reserve's decision to hike interest rates has been a significant factor in the economic slowdown. Inflation has been rampant, leading the Federal Reserve to increase interest rates to combat surging prices. This makes borrowing more expensive and intentionally slows down the economy. The Fed's display in raising rates has led to more drastic action, with the biggest single rate hike in 22 years occurring recently. Some of Wall Street banks even believe the Fed will engineer a recession to overcome inflation. The rise of near-term interest rates can tip the economy into a recession, and the anticipation of economic weakness leads to eventual interest rate cuts. This complex interplay between interest rates and inflation has created a challenging economic environment, with debates continuing in 2023 about the true state of the US economy. 2. Stock market turmoil. Next up, extreme fear has dominated Wall Street this year, with more than $7 trillion wiped out from the stock market. The Nasdaq has plunged into a bear market, and investors are concerned that higher interest rates will erode companies' profits. This has led to a significant drop in consumer sentiment, potentially impacting consumer spending, which makes up more than 2/3 of America's GDP. The decline in economic output and employment that recessions cause can become self-perpetuating, and the bear markets that often accompany recessions can reverse the wealth effect, suddenly making people less wealthy and further trimming consumption. The stock market's behavior is a complex and multifaceted issue that directly impacts the broader economy. 3. Bond market behavior. At number 3, there's a problem of investors not switching to bonds as they usually do when stocks are not performing well. Safe US government treasuries are selling off, and yields on the 10-year treasury topped 3% for the first time since 2018. The so-called yield curve inversion, where short-term bond yields rise above long-term ones, has preceded every recession since 1955. The yield curve inverts if yields on longer-dated bonds go down, while yields on shorter-term bonds go up. This behavior in the bond market is a significant indicator of economic health and has been a reliable predictor of recessions in the past. 4. Housing market dynamics. To add on, the housing market is on fire. As of August 23rd, the national average 30-year fixed mortgage rate crossed the 7% mark, and the median existing home sale price broke through $400,000 for the first time, hitting $410,200. High mortgage rates, elevated home prices, and constrained housing inventory have formed a trifecta of headwinds perpetuating the housing affordability crisis. The Federal Reserve's actions have indirectly impacted long-term home loans, with projections suggesting rates will still remain above 6% for the remainder of the year. Despite some optimistic takes, the housing market's recovery has been slow. Mortgage originations were at their lowest total since 2014, and existing home sales were down 18.9% from the year before. Limited inventory and high prices have continued to dampen home sales, and housing affordability has deteriorated significantly. Low housing inventory has become a challenge since the 2008 housing crash, and it still hasn't fully recovered. The country ultimately needs 4.3 million more homes, according to one analyst. 5. Labor market conditions. The labor market in the United States has shown remarkable resilience and strength, particularly in professional and business services sector. Since 2020, the U.S. has added 1.5 million jobs to these areas, reflecting a robust demand for skilled professionals. Unemployment has reached a 53-year low, and job growth has been strongest in sectors that require specialized knowledge and expertise. However, the labor market's positive outlook is not without challenges. Wage growth has been slowing down, indicating potential disparities in income distribution and earning potential. The impact of temporary layoffs and the ability of the labor market to maintain its momentum are also concerns that need to be addressed. The interplay between job creation, wage dynamics, employment rates, and other factors creates a complex picture of the labor market's current state and future prospects. 6. Consumer behavior and sentiment. Amidst all the chaos, consumers, quite surprisingly, are spending like crazy. But the word recession is being heard more frequently. Consumer sentiment dropped to its lowest level in 11 years in May, and this could be bad news because in the US, consumer spending makes up as much as 70% of gross domestic product, GDP. If people are confident about the future, they are likely to shop more, boosting the economy. In contrast, when consumers are uncertain about what lies ahead, they tend to save money and make fewer discretionary purchases. Gloomy sentiment weakens demand for goods and services, impacting corporate investment, the stock market, and employment opportunity, among other things. This is exactly what's bound to happen in the country if things continue to persist like this. 7. Government policies and global impact. And lastly, government policies, both domestic and international, play a vital role in shaping the economy. The Fed's decisions, trade policies, and international relations all contribute to the economic landscape. The ongoing global issues, such as Russia's actions and China's economic policies, also have a direct impact on the U.S. economy. Governments around the world have adopted fiscal and monetary policies to prevent a run-of-the-mill recession from becoming far worse. The role of government in shaping economic outcomes cannot be understated, and understanding these policies is key to grasping the broader economic picture. The American economy is at a crossroads. The signs of collapse are not mere speculation, but are grounded in tangible economic indicators. From debt to trade imbalance, from inequality to industrial challenges, the U.S. faces a complex web of issues. The question that lingers is not just numbers and policies, it's about the very soul of the nation. Can America rediscover its economic vitality, or is the collapse inevitable? Tell us what you think in the comments below. This brings us to the end of this video. If you liked it, please consider subscribing and sharing so we can keep bringing more content like this. See you next time.